Greetings, everyone. Thank you for joining us. I'm Dave Yeske, and with me are Yusuf Abujaderi, partner and chief investment officer at Yeske Buie, and Lauren Stansel, also partner and chief planning officer. Yusuf will be taking us through some really interesting information regarding the markets, the economy, and election years. And Lauren will be helping us stay on top of your questions and even helping us with a few polls. So with no further ado, take it away, Yusuf.
And that I will. And by all means, Dave, as always, jump in as you see fit. We want your commentary as we go through our conversation today. You can see the title, Election Season. Does the market care who's president? We're going to speak to that for the bulk of our presentation today. But before we dive into that focal point, we are going to do a couple of slides on performance. If you're a client of the firm or read our biweekly digest, you saw our write-up on returns through the first 4 months of the year. The first 3 weeks of May have been impactful and positive, so we'll look at that briefly, and then we'll get rolling on the main part of our presentation today. So with that, a quick refresher. Here's what returns look like through April 30th. We'll note a few things about this chart. Number one, anytime when we see funds with the word value in the title, and I'm coming to my annotate marker here because I want to highlight that. So value there, 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 and there. Anytime where we see value outperforming its corresponding fund, so U.S. large value relative to the S&P 500, international large value relative to international large, we're happy. And why? We tilt the portfolio in favor of value stocks being those that are priced more cheaply or inexpensively relative to their more expensive counterparts in the various areas that we're trying to get exposure to. So U.S. large company stocks, international large, U.S. small, and so on. So when we say that value stocks are outperforming their more expensive counterparts, we're seeing the value premium in action, meaning we're getting more in terms of return from value stocks, again, relative to the other stocks out there. So always encouraged when we see this kind of performance with value leading the way here, and that means good things for our portfolio. So through April 30th, the best performing stocks, U.S. large, both the value and the S&P 500, the worst performing, U.S. small, and global real estate. Now, if we pivot and look at the first 3 weeks of May, let's get rid of our annotations here. Note that the best performing stocks are what were performing worst through the first 4 months of the year. U.S. small value, and global real estate all here at the top of the heap. So it's interesting to note how things can turn on a dime, and happy to report that May has been wonderful in terms of market performance. The worst performer up 3% in 3 weeks. The best performing stocks up by more than 6%. And year to date, the stocks in our portfolio across the board, when you appreciate all of the stock funds we're invested in, up by more than 7% year to date. So to be up by that much, not even halfway through the year, that's good news. We diversify because, again, you never know when a certain part of the portfolio is going to take the lead in terms of performance. And just interesting to note that the bottom performers have become the top performers in just a short 3-week time frame. So with that, I'll pause for any comments, Dave, that you want to inject here before we dive into our main topic for today.
No, I think this is the main point that we want to make, is that these things can turn on a dime. And whatever categories are showing leadership in any given time period, odds are that the laggards will take the leadership position in a subsequent time period. If everything in your portfolio is performing identically in any given time period, it means you're not very well diversified. And this is such a great example of how leadership can change in a matter of weeks in a significant, notable way.
And speaking of leadership, the S&P 500 has been making headlines all year for setting new record highs. Through the first 4 months of the year, it was not the best performing investment in our clients' portfolios. And through the first 3 weeks of this month, it is not the best performing investment in our clients' portfolios. And we don't have anything against the S&P 500. We own it with intention, and we have to speak to its performance within the context of all the other investments in our clients' portfolios. So with that, we'll move forward and start to talk about elections and whether or not they matter and whether or not the market cares who's president. Of course, elections matter, but what we'll first focus on are the points that we're making here on this slide. 3 points, and then we'll have some comments about each one to set the stage for the discussion we're having today. So first of all, it is difficult to identify systematic return patterns in election years. And by that we mean it's difficult to say why the market is doing whatever it's doing at any given moment or in any given year with precision or specificity regarding one factor. It's just really hard to do that. The market represents a mechanism or an aggregate of information that's being processed and then indicating where things are headed in the future. And we're going to speak to that in coming slides. But it's difficult to identify one factor pushing things in a given direction when looking at performance. On to our second point. On average, market returns have been positive, both in election years and in the subsequent year. So it's important to note that during the year in which the president is chosen, markets have tended to do well. And regardless of who has won the election, in the subsequent year, markets have tended to do well. And so we'll move to the third point here. Market expectations associated with election outcomes are embedded in security prices. And it's just funny to note that in terms of expectations being baked in, I saw an article today that said the stock market had already picked who would be the next president. The argument in the piece being that if you look at the Dow Jones, the article was focusing on that particular index over the past 100 years, and you look at how the incumbent has performed in the election relative to how the market has performed. With good market performance, the odds are higher that the incumbent will be reelected. So based on market performance year to date, this particular piece was saying that Joe Biden had a 59% chance to win based on their predictor tool. Between now and election day, you'll hear no shortage of predictions about who is going to win. You will hear zero predictions about who is going to win in this presentation. But we thought it was funny and timely to share that point as it relates to this third observation here. So we'll leave this image as the backdrop and make this point and try to do so a bit more eloquently than I did on the previous slide. So again, what do we mean when we say the market doesn't care who's president? It's not that it doesn't matter. It's that regardless of who is president, markets are going to do what markets are going to do. And that is process information and indicate an expectation of where things are headed based on that information. And so it's important to also note that our worldview regarding markets, regarding the economy, regarding people, is that markets represent the aggregate of individuals' actions, and individuals are creative and resilient and growth-seeking, and therefore, the aggregate representation of their behavior should also exhibit a bias towards growth, regardless of who is president. And now to the chart. So if you look, this is an upward sloping line, irrespective of the color that you're showing in each of the various segments, whether it was a single term president or a dual term president, a Democratic president, a Republican president. The market, which is represented, this is the S&P 500 over the past 100 years, we'll call it, has demonstrated a consistent upward sloping trend. And note, by the way, this axis is showing values at an exponential rate, growing from 10 to 100 to 1,000, so by a factor of 10. So if we were to actually appreciate, this chart in nominal terms, the slope would be dramatically higher.
You just couldn't fit it all on one slide.
Right. Even Elisa with her 4 screens, with 2 screens stacked on top of these 2 screens, wouldn't be able to fit it. And so the point being that markets,
go ahead, finish your thought.
Do well. Markets do well regardless. By all means, Dave, jump in.
No, I was just going to say, the thing is we're not saying that elections are not consequential.
Right.
What happens politically, what happens in an election year and every other year, it matters. It's important. It's just not as important to the economy and the markets as we might assume. The most important factor is that 300 million Americans and 8 billion people worldwide going about the daily business of earning, saving, spending, and investing are going to drive what happens in the economy and the markets far more than who's president of the United States or who's prime minister of the UK or any other political leader. Those things matter. They just don't matter so much to the economy and the markets.
Here.
I wanted to jump in quickly, Dave. This reminds me of the story we heard last week at an FPA meeting, an analogy of what it's like. The presenter was talking about this same topic and said, I bake cookies with my daughter a lot. And when you're baking cookies, you have a recipe, you have all of your ingredients, you open the bowl, you get a bowl, you've got flour, sugar, brown sugar, vanilla, eggs, butter, chocolate chips. You mix it all together, you put the cookies in the oven, you take them out. And when you open the cookie, you can't look and say, there's the egg I put in. There's the flour I put in. It matters. You need it to make a good cookie, but you can't pick it out after the fact.
And likewise, when you're looking at returns, it's hard to point to, the role the specific president of a time period played and point to them and say, there's the egg, right? And we'll deconstruct some narratives that you could glean from some of the images that we're going to show you. And again, return to this point again and again throughout this presentation. And thank you, Lauren, for sharing that anecdote. I'm jealous that I missed that presentation because it sounded like it was a really good one. And as we were teasing on the previous slide, let's look at the returns. We'll highlight 4 presidencies here, 2 Republican, 2 Democratic. Clinton's and Obama's, the 2 instances in which market returns over the period during which the individual named was president, where we had the highest returns. During the Clinton years, markets were up 210%. During the Obama years, a paltry 181%, right? Now, looking at, I'm being sarcastic, obviously. If we look at the Nixon and Bush years, market returns in the negatives, double-digit negatives, minus 20% for Nixon, minus 37% for George Bush. To give the credit of these returns to either President Clinton or President Obama, or blame President Nixon or President Bush for the negative returns during their presidencies, would be really short-sighted and would ignore so many of the other factors that were influencing market returns during their presidencies. We'll actually highlight President Bush on a coming slide, so I'll ignore or save those comments for a later slide. But let's focus on Bill Clinton for a moment. Does Bill Clinton deserve credit for the development of the internet? A joking reference may be that Al Gore deserved more credit for it. But if we're in all seriousness, Bill Clinton didn't invent the internet, nor was he responsible for the tech boom that drove market returns, specifically in the US through the 90s, through the roof. He just so happened to be president at that time. And we could draw similar narratives from all of the other presidencies that you see here and deconstruct them just as easily, just by looking at one other variable. And the point here being, there's thousands, millions, an uncountable number of variables that are influencing market returns at any given point. And so trying to focus on one singular variable, even if that is who the president is, isn't a way to actually break down the full story of why markets are doing what they're doing. Let me pause here before we go on to the next slide. Dave, anything you wanted to add here?
No, and I think you're going to make a point about George W. Bush's presidency. There are macroeconomic factors that for which the president cannot be praised or blamed that are always at work. You just have to look under the hood, as you just did with respect to President Clinton and are about to with President Bush.
Indeed. We'll make a comment here that the market also doesn't really care who's controlling Congress. Again, we make that comment in the same vein as the prior comment. Same chart, it's just that the breakdown here is showing you when the Republican Party had control of Congress, when the Democratic Party had control of Congress, or when that control was shared between the two parties. And again, the pattern is the same. Market returns, we're showing the S&P 500 for, again, about 100 years. On a logarithmic scale, with returns being positive over that entire period by and large. And so before we go to the next slide, Lauren, if we could show our next poll question that we have here regarding about how markets performed depending on which party had control. So I'll tee this up as we launch the poll question. But we got this from the same presentation that Lauren shared the cookie anecdote from. So does the market perform better when we have a unified Republican Party in control or a unified Democratic Party? Meaning the executive, legislative branches, both houses, and the presidency, all covered by the same party. What does the performance look like? And I believe, correct me if I'm wrong, Lauren, this was since 1950 were the years where we had these this kind of control?
I think it was longer than that.
Yeah, we've got two options. So we have your slide later. That was since 1950.
Oh, that's the one I'm referencing, right.
I've got some details further back, 1926, I believe.
Brilliant. Okay, perfect.
We've only got about 50% of people having given their answer. So I'll give it another 15, 20 seconds, and then I'll end it and share the results with everyone so they can see on their screen. All right, we've got more coming in. It's like watching a horse race. All right, we'll give it about 5 more seconds if anyone is there and wants to add your guess. All right, Yusuf, I'll go ahead and end this and share the results. So hopefully everyone can now see those results of where people voted.
Yes, and looks like more than half of the respondents could tell where this was headed. Lauren, help me make sure that I get these stats right, but we're looking back almost 100 years. There were 33 or 34 years in which the Democratic Party
34
had unified control, and 13 years in which the Republican Party had unified control. And here's where it gets crazy. The average annual return was the same. And when we say the same,
to the second decimal point.
Second decimal. 14.52% per year on average, regardless of which party had unified control. And that stat was literally mind-boggling. When it was shared by Lauren and Dave after they had attended that presentation, I started cackling out loud. It was late. I was preparing for the webinar earlier this week, and I had to share with Megan, my wife. She said, "Why are you laughing?" And I said, "You're not going to believe this." So thank you for that. And thank you for all those who responded to our poll here. And, you know, we have a slide here coming up next that's going to tell the same story, but with slightly different numbers. Rather than looking back 100 years, we're looking back to 1950. That's where that reference came from earlier in the comment I was making. And the same is true. Slightly different time period, but we're going to treat these returns as relatively equal. Again, it's a large sample size in terms of years. And when looking at the performance, the important thing to note here is it's been positive, irrespective of which side of the line you're looking at on this image. And so it's not just the market. We'll make the same comment about the economy. If you've ever paid attention during the run-up of an election, The economy comes up a lot in addition to the financial markets and how performance is going. And one of the pieces of the economy that is often focused on the most is the labor market. What about jobs? Is the next president going to create more jobs? How is job stability going to be affected by the next president, et cetera, et cetera? Job market stability, I should say. So 3 charts here, and these charts, this image is not meant to make an argument for either president. We're looking at President Trump and President Biden, our current and most recent president. This is not an endorsement of either, but a note that if we look at the trend established under President Trump as it relates to, for example, average hourly earnings, the trend was positive before Biden came into office and was unaffected after Biden came into office. Likewise, even if we look at real earnings, right? So inflation adjusted, that number was and continued before actually bouncing and returning to maybe a stable number. Maybe we're seeing a trend here of stability after Biden came into power. You can make the same claim about the unemployment rate. This spike, nothing to do with who was sitting in the Oval Office and everything to do with COVID. But the trend improved under Trump and continued to improve under Biden. And the same being with the labor force participation rate. Not a meaningful change in that rate or after the presidency changed or shifted.
A once in a century global pandemic, that'll knock you for a loop.
Yeah, I'll say. I mean, we're still processing it some 3-4 years later, all the after effects, and I think that'll continue for some time. But on a similar note, and looking, that gray bar here is representing the recession caused by COVID. If we look at the economy more broadly, not just focusing on jobs or the labor market, but let's look at GDP, right? So gross domestic product, economic output. If we look at this purple line, there's a clear trend line over the past 8 years. And that trend has been persistent. Irrespective of whether Trump or Biden was in office. Again, the only dislocation being as a result of COVID. The same being true on the orange line, that's inflation adjusted GDP. So again, gross domestic product, the measure of all economic output, but now adjusting for inflation. Average annual growth, even with the inflation issue that we've been dealing with for the past several years, 2.3%. Gross GDP has been growing, by the way, by 5.73% on average year over year over the past 7+ years. And that's including the dip, by the way, from COVID. So a tremendous number there. And we're seeing, we also have interest rates overlaid on this chart, just to note the impact of a strong increase in interest rates over the past couple of years. That also has not slowed the economic output or economic growth that we're seeing in GDP. Go ahead.
This is well, I was just going to say, this is something that is actually if we want to talk about historical precedent, this is somewhat unusual. Sure. That the Federal Reserve would raise rates as dramatically as they have and not see the economy slip into a recession. Normally, if you look at a chart of the last 50 years or the last 100 years, and you see these gray areas that show recessions, if you map those against changes in interest rates, what you find is that almost invariably when the Fed raises rates like this, it slows the economy down, which is typically the Fed's intention, because in slowing the economy, they also lower inflation. And here's a case where inflation has been coming down since 2022, and yet the economy has continued to grow strongly. So we've got some kind of magic sauce going on right now that is somewhat unusual from the historical perspective.
And we will take it.
Yeah, every time.
History, Dave, it's a perfect segue. We've done a bit of a deep dive into 4 of the presidencies that we've been referencing throughout this conversation. And we thought this was an appropriate slice of history to focus on because it provided a significant sample size. We're talking about 20 plus years, and also a quote unquote fair sample size. You have 2 Democratic presidents, 2 Republican presidents, 2 two-term presidents, and 2 single-term presidents. And so as we go through the presidencies of each George W. Bush, Barack Obama, Donald Trump, and Joe Biden, we'll share some economic statistics just to set the stage for that time in our nation's history. We'll also have in the background a sampling of returns from years during that presidency that indicate when the markets experienced challenging times. And we'll also show how our portfolio performed during each of those respective. So as we go through here, we'll just provide some comments, what we remember, what we observed, and how the portfolio did as it relates to each of these 4 presidents and their terms in office. And so we'll begin with George W. Bush, who, as it relates to this conversation and the research that I was doing in preparation for today's discussion, must have been the most unlucky president in our nation's history in terms of timing. Between 9/11, the dot-com meltdown, the housing meltdown, and the financial market collapses that followed those 2 meltdowns, what George W. Bush had to navigate in terms of financial and economic conditions was just unique relative to some of the other presidents that I observed during this time frame. 8 years in office, unemployment peaked, at just about 8%. That was during the financial crisis towards 2007 and 2008, towards the end of his presidency. Inflation on average about 2.3%, right in line with the Fed's target, so all good there. And GDP growth at a muted 2.2%. Expectations or desires would have been higher. But let's look at what the market did during that time. And at any point, Dave, jump in here, please. During 2000, when markets started to really take a dive, you can see that the benchmark against which we measure our performance, the All Country World Index, in 2000 was down 10%. Our portfolio, which is not as heavily skewed towards large company stocks, is globally diversified. So there was a healthy amount of international stock in our portfolio. And as we mentioned earlier, a tilt in favor of value stocks and small company stocks relative to what we were seeing in the global market. The tilt that our portfolio exhibited and having the international exposure helped our portfolio account for a 22.5% outperformance relative to the benchmark that year.
A lot of that was
massive.
International small company stocks, things that have not dominated so much in recent years. And it was the same thing in the late 90s. In the late 90s, it was a very similar period to today, where you had a handful of big tech stocks that were dominating the market. Cisco was trading at 300 times earnings, and other large growth-oriented stocks, especially technology stocks, were dominating the market. And so a lot of, in the final years of the 90s, I had a lot of people asking me, well, why do we have these small company stocks? Why do we have these international small company stocks? They don't seem to be advancing as strongly as the growth stocks, and especially the technology stocks. And then came the meltdown of 2000. And the NASDAQ, by the way, which was very tech heavy, fell 80% in the year 2000. So if you were really focusing on tech, you got slaughtered in 2000. It was those small company value and especially international small company stocks that came back and rescued us. International small was up, global real estate was up, bonds were up. All those things that people were questioning in 97, 98, 99 came back and rescued us in 2000 when the rest of the world was falling apart.
And we see that bear out in the returns. And the outperformance continued throughout several of the years that overlapped with George W. Bush's presidency. And you'll note that everything that Dave was just commenting on in terms of market performance had nothing to do with who was president. And we don't mean to be cheeky, we're just making the observation as it's aligned with the point that we're trying to make today.
And although this slide says Barack Obama, it's important to note that 2008 was the last full year of George W. Bush's presidency. And this is to a significant degree why he shows up with a negative return for his tenure, because it began, as Yusuf said, it began with the dot-com meltdown and it ended with the Great Recession, which began in late 2007 and really hit its absolute low at the beginning of 2009.
Yeah, and not George Bush's fault that markets started to recover the year after he exited the White House, nor Barack Obama's, nor to his credit. But it just so happened that the first full year of his presidency, markets experienced a dramatic return. Our portfolio and our benchmark up by some 25%. But his presidency was no picnic either. I remember it was the beginning of my career. The word or phrase double dip recession, I think, was said multiple times a day, every day. Everyone was waiting on the other shoe to drop. It didn't happen here, but we did see some real challenges in the Eurozone, specifically the Greek debt crisis in 2011 and 2012, markets going through some challenging times there. And then some issues with China releasing lower than expected growth projections after years of double-digit growth year after year, which threw markets in a tizzy. And so certainly was Barack Obama's leadership appreciated throughout this period? Yes, same as George W. Bush. But can he take credit for how markets responded to these challenges? We don't think so. Again, the refrain remains the same. I'm going to spend less time on President Trump and Biden just because those years are a bit more recent. We all remember much of the past many years, and certainly the COVID years, while blurry, are all still fresh in our minds. The tables here look the same. Our portfolio either keeping up with or outperforming the benchmark, irrespective of what the challenge was that markets were facing. You can see here the unemployment number looks crazy, almost 15%. But again, recall that the economy came to a screeching halt in March of 2020, and of course had nothing to do with who was president, but certainly did affect markets and the economies around the world.
And actually, to the degree that the U.S. government and our and the Federal Reserve, our central bank, reacted to the shock of COVID, it was completely bipartisan. The Fed flooded the system with liquidity. Congress, in a bipartisan way, appropriated vast trillions of dollars to cushion the impact on individuals across the country. So this was a case where it didn't matter so much who was president. It was the reaction or the response to try and take some of the pain out of this for individual citizens was absolutely bipartisan.
Absolutely. And the policy decisions continued across presidencies. There's the initial injection of trillions of dollars into the market under President Trump, and that activity continued. Those decisions continued under President Biden. And so, much of the commentary around these performance numbers we've made in recent digest posts and webinars. So we'll skip past this because I really want to spend some time with this image. Those of you who are regular watchers of our webinar or regular readers of our digest know that I think in chart, and I think that a picture is worth 1,000 words. And this picture is especially compelling because we get to make this statement in the context of what we've been talking about for the past few slides, and then really dig into it. The statement being, what if I told you that over 4 presidencies, again, 2 from each party, and a more than 20-year period, that in economic terms, the following that we'll speak to, we ended exactly where we started. The unemployment rate changed by 0%. We were at full employment in the year 2000. At the end of the year 2000, we're at full employment now. Full employment defined by an unemployment rate of 4% or less. That number was 3.9% 20 some odd years ago. It's 3.9% now. The same is true for the inflation rate. It's 3.36% now. The inflation rate was about 3.4% some 20 years ago at the beginning of this particular period. The unemployment rate is represented by the red line here, and the inflation rate represented by the green line. You can see they bounce and spike upward every time we have a recession, as represented by the gray bars, and then return to the trend line in either case. And again, 8 years initially of a Republican president, followed by 8 years of a Democratic president, followed by 4 years of a Republican president, and we're now in the midst of Joe Biden's presidency. And through it all, and here's the most critical piece, GDP, represented by the blue line, average annual growth of economic output of 4.4% over a 20-year period. That's 3 recessions, 4 presidents, and a really strong growth rate.
And the economy the economy just grows. You know, there've been a lot of studies looking at how good economists are at predicting various economic variables. And what we found is that economists are terrible at making predictions. If economists try and predict interest rates, inflation rates, any number of variables, they have a bad track record, except for gross domestic product, because that's the one thing they're good at predicting, because it's just a positive trend with relatively little variation over time.
Yeah, I mean, you grow to the size of your fishbowl is the way my dad always put it. And in terms of the economy, that's just the way it works, right? People want more tomorrow than they have today. Prices rise, and people go about the business of making sure they can afford to buy more stuff and plan for their futures and address their problems day after day after day. It happens at the individual level, and it aggregates up to an image like this. And when we see this, this is why we have the kind of reaction where we say the market doesn't care or the economy doesn't care. It's not that it's unaffected. We just have the belief and the evidence over the past many years, we're focusing on quarter of a century here, that is what's going to happen based on what we've seen.
And I think that the key here, and it's really, you've been saying it, it's about human resilience. The blue line is telling us that whatever else is going on in the economy,
right?
Inflation is going up, inflation is coming down, employment is going up, employment is coming down. Human beings adapt, and their resilience and adaptability is why that blue line looks so consistent, even in the face of inflation that's highly variable, employment levels that are highly variable. And we could put other economic series up there, and you'd see lots of variability, but the blue line is very stable because human beings adapt to whatever comes along.
And in terms of whatever comes along, I think it's interesting to note these 3 recessions are in and of themselves unique. It's not like we had 3 of the same type of recession. This was a tech shock. This was a financial markets issue, right? Interest rates and real estate and pressure on banks and all of that kind of thing. This was a health issue, a health and safety issue, an existential crisis. So 3 separate recessions, 3 totally different types of pressure on the economy. And the result was the same. Human beings figured it out. And again, growth continued. So, you know, we look at this stuff, we talk about this stuff internally all the time. And it's just fascinating when you can look at the data and it validates the worldview. And that makes sense. We operate in an evidence-based way. Of course, the worldview is shaped by how we process the evidence.
So I've got a few questions coming in, Yusuf and Dave. I think maybe go back to that slide because a few of them have to do with this slide. Well, first, I want to let you know that you have a new nickname. You are the Yesky Buoy Wizards. That's what you've been named in this question. But 2 questions really relating to GDP. How is it sustainable for GDP to continue growing? Excuse me. And what will be the fuel for that GDP growth in the coming decade, let's say? That's the first one.
Dave, I'll take an initial crack, but I'll defer to any additional comments you want to make here. The confidence that it's going to continue to grow is people. In a word, there's more people than there ever have been, and there will be more people. And so as those people go about the business of consuming and saving and investing, again, that behavior aggregates up to businesses, nations, countries, and so on. And then that's then borne out in the information that we digest as we look at how the economy is performing. But a pause there. Dave, what would you add?
Well, I would add, yes, I mean, a growing population is an important part of that. And we see innovations. The constant is that human beings are always innovating. We have in the 90s, we had innovations in technology that gave rise to the internet and all kinds of efficiencies and supply chain efficiencies that flowed from that. We couldn't live today without our internet connected phones and our computers and all of the rest. But they all came into existence basically in the 90s, at least in anything like the form we see today. Those innovations formed a foundation for subsequent growth. We've had innovations in finance since 2000. And going forward, I mean, all the usual sectors are going to continue to chug along. People are going to build homes, and they're going to develop new technologies. We have, artificial intelligence, generative AI is all of a sudden the watchword everywhere. We don't even know what that will lead to in terms of new innovations, new opportunities for growth in the economy. We have the growth of green technologies. There's an explosion in other sources of electricity. The solar cells get more efficient every year. We find new ways to generate electricity. We find more efficient batteries, growth in electric cars. I don't happen to own an electric car, but everywhere I go, I see nothing but Teslas on the road. So, that's going to continue. But human beings are going to find new ways to create new and more interesting products. Innovations in finance, fundamental industries like real estate, construction. I mean, those things are all going to continue because we have to, because human beings will have the same needs, the same desires. So this is, I guess we could go on and on, but this is the fundamental thing that's going to drive it is human beings seek to make their lives better for themselves and their families, and they find new ways to do it. And this is the driver of this pretty stable blue line we're looking at.
So one more related to that, Dave, you were talking a bit about green technology and energy sources, but what do the Yesky Buoy wizards think about the possible effect of climate change on GDP growth?
Oh gosh. First of all, Noah, my son, is going to get a kick out of this wizard thing. He's a big Harry Potter fan. And I appreciate the compliment. In terms of climate change, I would refer back to the response that Dave was just sharing. It's yet another challenge, and it will create an environment in which humans will need to respond and innovate and adapt. And in so doing, there will be opportunities for growth. How that's going to happen specifically, again, I'll refer to another comment that Dave made, and I don't mean to be cheeky, but it is true. Economists are terrible predictors regarding the future. What we are really good at is making sense of what's happened after it's happened. So continue to tune in as that becomes a bigger part of the conversation. We'll have commentary on that. But I'll pause there. Dave, what would you add?
This is a case where I think it's really important when we explain our worldview and how it fundamentally begins with human nature and the propensity of humans to be resilient and adaptable and growth-oriented. It's important that we don't seem delusional. We're not unaware that there's bad stuff happening in the world every day. You just have to pick up a newspaper. I mean, if it isn't bad, it isn't news. And the newspapers are plenty full of news. Bad things happening every day all over the world. Some of it involves, the horrors of war, whether you're talking about Russia and Ukraine or what's going on in the Middle East. And some of it involves bigger global issues like global climate change, which is real. And it's something that human beings are going to have to adapt to. We're not delusional. We know there's lots of challenging things happening in the world, including climate change. But we have some faith that human beings are going to continue to adapt. We, as a species, human beings maybe adapt later than some of us would like. We can look out on the horizon and say we need to get ahead of the curve, and oftentimes human beings don't get ahead of the curve. They deal with things more in real time. It was kind of like Y2K, since we're going back 20 years with this chart. You know, some of you who are old enough may remember that in the late 90s, Y2K was a huge issue. People were convinced the world was going to come to an end in the year 2000, that planes were going to fall out of the sky, you wouldn't be able to get cash from your ATM, that all computer-based systems would fail, and it didn't happen. And it didn't happen not because the challenges of Y2K weren't real. It was because people dealt with it, companies dealt with it, individuals dealt with it, and they managed to deal with it by the time the crisis was scheduled to arrive. And so, yeah, we could be more ahead of the curve in terms of bending the curve on anthropogenic climate change, but we still fundamentally believe that human beings will find ways to adapt and ultimately bend that curve. And we're going to have to live with a warmer planet and more volatile weather systems, and we'll have to adapt to that. So these are not good things. These are negative things we're going to have to adapt to. But we don't think we're going to descend into some kind of a Mad Max dystopian world. We think human beings are going to find ways to adapt and get through it.
So I've got a few questions coming in here, Dave and Yusuf, that I probably am not going to read word for word, just because some of them are, you know, I know we're not making predictions about who's going to win this presidential election, but people are feeling concerned and have been for some time about what the outcome could be, what this presidential election looks like compared to all those elections you were reviewing earlier, Yusuf, and how it feels. And you know, one of these is self-admittedly possibly a minefield to discuss, but just what your thoughts are on what it could look like if there are tariff issues, immigration issues, how that could affect GDP. And Dave, I think what you were sharing really kind of hits home our broadest thoughts about human resiliency and adaptability, but just what it could look like if there's serious internal strife in our country or broader war throughout the world.
Yeah, I'll make some allusions to, I watched Oppenheimer for the first time recently. And I don't mean to make light of any of the issues that I'll make reference to. But I appreciate that it could come off that way, given that I am 37 years old and wasn't even around at that time. But I would imagine, and based on my understanding, not just from the movie, but my understanding of how human beings were feeling at that time, it was an incredibly challenging and stressful time. And the world was at war. And yet, somehow, some way, we figured out a way through it. And that theme echoes throughout each of the instances we could look at. We could look at how things felt the last time these two candidates were both running for office. That was 4 years ago. And you know, COVID had come around just 8 months prior. And that was a really raw time historically. And we figured it out. And so that's not to dismiss the concerns of the day. But it is to say that the only precedent that humans have established to this point is that we will persevere together. Our best odds forward are enhanced by working together. But that's my view. And so I'll pause there. Dave, what's your take?
Well, I mean, and the question included some very specific things like immigration and tariffs, and
yes,
and those things could have a real impact. I mean, you know, we had a lot of tariffs that began under President Trump, and President Biden ended up continuing many of those tariffs and actually increasing some of them. What's interesting is that while tariffs tend to increase prices. I mean, honestly, they tend to be inflationary. The consumer tends to pay the tariff, not the exporting country. And so they do have an impact. And immigration can have an impact. I mean, this country, the United States, if we're talking specifically about the United States, one of our strengths as a country vis-a-vis other developed countries has been the fact that our population has continued to grow. And that's very healthy for the economy. Many other countries are like Japan and Germany and the rest of the EU, their populations are aging, their populations are not growing, and the US also also is not doesn't have a birth rate that exceeds replacement rate, that even matches replacement rate. The only reason that our population is not shrinking and our population is not aging as fast as other developed nations is because of immigration. If we had a complete shutdown of immigration, we'd feel it. But for all the rhetoric, immigration has continued through the Trump presidency and the Biden presidency, and we might want to control it more. We might want to have less illegal and more legal immigration. But these are things that happen at the margin. A lot of things that become highly politicized, when you look at it in the grand context of a, of a $29 trillion economy, what you find is that these are things that are happening at the margin. And so I think that's one of the things we come back and look at is that, I said it before, what 300 million Americans do on a daily basis in terms of the decisions they're making day by day in terms of earning, saving, spending, and investing are going to have more impact on this $29 trillion economy than who's in Washington and decisions they're making about whether or not they should have another tariff on Chinese imports. And that's true likewise. And we're global investors, as I think you all know. Half of your portfolio is outside the US because half of the market is outside the US. And so now we're talking about 8 billion human beings across many different countries and many different political regimes going about the daily business of earning, saving, spending, and investing and caring for themselves and their families. And at the end of the day, if we just look at the historical record across all countries and across the globe, through war, through famine, through changes in political regimes, the global economy has tended to grow and expand, and the global stock market has tended to grow and expand. And so it's like, there's an old saying on Wall Street that's 100 years old, and it's the market climbs a wall of worry. And it's basically, part of the insight that we've been trying to share here, and that is that bad stuff is happening every day, but human beings on average are overcoming the bad stuff. So it's not to deny that there's bad stuff out there. It's just to say, you know what, our 300 million fellow Americans and our 8 billion fellow human beings are generally going to be growth oriented and resilient and just overcome this stuff. And it's not that it doesn't matter. I worry about this election as much as anyone. I worry about the future of the US politically as much as anyone. I worry about the future of the world. And I nonetheless fall back on a faith in humanity. And I do my individual part. I try and do my good works, and I give to charity, and I volunteer, and I see people around me doing the same thing. But I have a faith in the whole, and I have a faith in the aggregate goodness of human beings.
Well said, Dave. Lauren, do we have any more questions?
We have another one that came in through the chat. Just a question about inflation. Is there an easy explanation for why inflation is theoretically easing and yet it feels like almost everything is going up in terms of cost?
Sure. First of all, the information that's reported is backward looking. So when you have the inflation print this past month or this May, it's showing you, measuring information through the end of April, and it's looking back 12 months. And in and of itself, CPI, Consumer Price Index, the headline measure of inflation, is a noisy variable. There's a lot that goes into it that economists are constantly having to parse out and explain and control. And so it's a measure, it's an indicator of where things are headed, and it's not necessarily always going to be a one-for-one representation of your experience when you're purchasing something. So whether it's groceries, it's going to be informed by all the factors that inform food prices specifically. That's just one part of the inflation measure. We also look at go ahead, Dave.
No, I was going to say I think that's the key point. You just nailed it, Yusuf. It's like the general level of prices might be falling, right, but that doesn't mean every category is falling. And the category the category that matters most to you might in fact be rising. There was a big article the other day about the fact that $100,000 a year is becoming the norm for many prominent universities across the country. And so it's like, if you have teenagers or kids you're trying to put through college, and all of a sudden $50,000 looks like a bargain and $100,000 may be on the horizon, you're not feeling like inflation is doing you any favors at all. So it's you can have simultaneously have a general fall in the price level and still have individual items that are hitting your budget. And I think that's one of the things that we're seeing is that people are focusing on the things in their personal budget that are not falling, even if everything else is falling. If obviously the price of gas is one of those things that everything else might be falling in price, but if the price of gas is not falling and you have to gas up your car twice a week, it's going to feel like things are out of control to you.
Yeah.
And so
absolutely.
both can be
Same
true
with
at the
food
same
prices.
time.
Yes. Yes, exactly. Maybe time for one more.
I don't have any additional questions at this moment. Just a thank you to the Wizards, and the person who gave you that name said he will not charge for the new nickname. No royalty fees.
We have a good intellectual property attorney. Maybe we should service more of that.
Well, this was a fun one, Dave. Thank you.
Yeah, this was fun.
Thank you,
And
Lauren.
just a note for everyone, this has been recorded and will be posted on our website in the coming days. So if you want to revisit, if you want to share it with anyone, please feel free to do so. And if you think of any questions after the fact, feel free to reach out to any of us.
Well,
Yeah.
and thank you for joining us. And you know what? If we wrap up in the next 60 seconds, it'll be kind of a record. We'll have come in under 1 hour.
Magic.
Thank you for joining us.
Beautiful.
We look forward to the next time. And obviously, always reach out to us, give us a call, send us an email if you have further questions. Yusuf and Lauren and I, you can't shut us up if you really want to dive into something more deeply than what you've seen today.
And with that, we will close. Take care.